business news now. Charles is with us. He's starting with a check on the state of the Chinese economy, aren't you, Charles?
The world's second largest economy published its official data for the second quarter this Wednesday, and it paints a picture of relatively weak growth, defined by a surging export sector offset by slow consumer demand. Gross domestic product growth, so the combined added value of production of goods and services in the country, was at 4.3% in the second quarter of the year. That's the weakest quarter the Chinese economy has seen since the end of 2022, when it was hard hit by the COVID-19 pandemic. This is significantly lower than the 5% rate it saw in the first quarter of the year, and it is underneath the official target set by the government for the year, which is between 4.5 and 5%. However, that target is still expected to be met by the end of the year.
So what's keeping the Chinese economy going right now, Charles?
Well, quite simply, it's the export sector, which is worth about 20% of the total GDP. Earlier in the week, the country's customs agency showed that exports had risen 27% in June compared to a year earlier, an acceleration compared to the May figure and way ahead of analyst forecasts, as you can see there. A big chunk of that growth came from the artificial intelligence boom. Outbound shipments of semiconductors were up more than 120%.
So what's the success of the export sector hiding then?
Weak consumer demand, weak domestic consumer demand, which in big part comes from the country's property sector slump. Many households had stored their savings in real estate. It was a huge part of the economy. Some said almost a third at one point, until 5 years ago, when a change in government policy was followed by a crash. Those same households are now unwilling to spend what they have left. And the latest data is showing a recovery in that sector is still far off. Property investment in the first half of the year is down 18% on the year. So are property sales, which are down 11.6%. And the number of new construction projects has also dropped by almost a quarter. So what happens now? Well, China's Politburo will be meeting this July, and experts will be watching closely for any signs of a stimulus plan to get China's domestic economy going again.
Is all this affecting the markets then, Charles?
Well, Asian shares mostly rising this Wednesday, tracking a rally that we saw on Wall Street, this following a report that showed U.S. inflation was not as bad last month as economists had expected. Shares in Hong Kong rising, while the Shanghai Composite is trading lower after that fresh Chinese economic data. In Europe, meanwhile, we're seeing a softer start to the trading session. All major bourses in the red, as you can see there. Those inflation fears in the U.S. still a concern for investors in spite of the positive data for the last month, especially with the Iran war seemingly not close to being settled. And the U.S.'s new Federal Reserve Chair, Kevin Warsh, made a point of saying that would be his main objective at the central bank, meaning higher interest rates are a possibility. Take a listen.
My colleagues and I recognize that high inflation has been an undue burden on American households and businesses. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability.
Something a bit different from Charles now. We're taking you to Gibraltar. Residents and their Spanish neighbours are celebrating a reunion, well, a reunion of sorts anyway.
As of midnight on Tuesday, border checks between the British Overseas Territory and the neighboring Spanish town of La Línea de la Concepción officially came to an end following the signature of a treaty between the EU and the UK. It's a relief both for the enclave's business community and the Spanish commuters who make up some half of its workforce. Brian Quinn has the details.
A celebratory mood at the crossing between Spain and Gibraltar as midnight on Tuesday brought the return of free movement across the border.
It's going to be a drastic change, I think, for the better, because we're no longer going to have to rely on whether there's a queue to get in or out.
Located at the southern tip of the Iberian Peninsula, the 6.8 square kilometer enclave has been a British overseas territory since 1713, a distinction with little practical effect while the UK was part of the EU. But the finalization of Brexit in 2020 saw the return of a physical border between Gibraltar and the neighboring Spanish town of La Línea de la Concepción, a major headache for the some 15,000 Spanish commuters who make up half the enclave's workforce, and a blow to the already struggling economy of La Linea, where unemployment hovers around 30%.
The borderline could be 4 hours long, sometimes even 7 hours.
While Gibraltar has one of the highest per capita incomes in the world, the enclave's business community had long warned that a hard border would damage its economy. Last year, a deal was struck between the EU and the UK that effectively brings the territory within Europe's Schengen zone. The treaty, signed in Brussels Tuesday ahead of the border opening. Goods sold in Gibraltar must now comply with EU regulations, and a new transaction tax starting at 15% will replace its import duty. In 2016's Brexit referendum, Gibraltarians voted overwhelmingly to remain in the EU. Tuesday's treaty bringing relief as years of uncertainty come to a close.
Brian Quinn reporting there, and Sean Pellegrin with Business.